Hi everyone, welcome back to the Proper Podcast. You've got my co-host Mike, as always. And
how's it going?
Christian, who was kind enough to, obviously it was a really interesting topic last time, so this is a continuation from what we initiated the topic of, financial independence on last episode. So this is going to be, a nice little segue into, different elements of that and what that entails actually in a practical way. So thank you both. And thanks, obviously, Christian, specifically for giving your time to share your insight on this. So,
Thanks for having me.
Yeah, no problem, anytime. And without any further ado, obviously, Christian, I'm just gonna hand over to you, and I'll let you sort of like give our audience a bit of a recap as to what we discussed last time, and we'll take it from there.
Yeah, cool. So again, let me start by thanking you guys for having me. I enjoyed last time. It was really fun. So appreciate you letting me come back and talk to you guys again. So where we left off last time, the biggest takeaway, at least in my mind from last conversation, was what are priorities when it comes to kind of coming up with your own financial independence, building towards that. What are the three priorities, right? We talked about putting a little bit of money away into saving for retirement, getting some emergency cash saved up so you have a couple $1,000, and then starting to pay off debts, right? And those were kind of the three primary topics, and that's the general order you want to go in. Now, as we wrapped up, I was giving you guys a quick example of the power of compounding and the power of investing and what it's actually good for. So I don't remember the specific numbers, but we basically used Mike as an example. Said if Mike is, what you said, Mike, you're what, 24, 25?
Yeah, around there.
Okay. So if you're 25 and you've got, let's say you want to retire at 60, right? So you've got, 35 years ahead of you, and you invest, 10% or so, 15% of your pay between now and then. And that's between you and if your company's going to give you any money, your company as well. Yeah. And you do that for that 35 years and you get average stock market returns, which is around 10, 11%, at least in the United States. I can't speak abroad, Fatty, but here in the US. And that would leave you with, roughly speaking, $4+ million by the time you turn 60 years old.
Nice.
Right?
It's a nice number. I know that.
Yeah. And a lot of people, that kind of blows them away, but it's really actually not all that difficult or hard to do, to be quite frank. Another little point I would add before we move on is when you hear people talk about being a millionaire, a lot of people think that means you have to have $1 million in cash, right? That's not how it works, right? If your assets, meaning everything you own, your home, your stocks, your cash, everything, if your liquid assets that you own are over $1 million, you're a millionaire, right? And it would not be far-fetched at all for all three of us to be a millionaire by the time we're 40 years old if we do these things. Not far-fetched in the slightest, right? You got a $300,000 house when you're 40. You've got $350,000 in retirement savings, and you've got $300,000 worth of, cash, property, land, whatever you've bought and collected over the next 20 years from now. Really wouldn't be that far-fetched. So anyway, that was kind of a recap from last week. But to pick up today, we are going to talk a little bit more about specific investment types. How do you actually get to that point where you can start, putting the money in and saving it and letting it grow so you can get to that $4 million? How do you get started doing that? And then what are some strategies that you can use as we are kind of getting further and further down that path? Yeah. So let's start with how to get started, right? I think because originally I put that second on my list, but I think that's the most sensible place to start, right? Is how to get started.
Yeah, definitely.
Yeah.
Now, again, Fatty, I say this for you because I don't have a bunch of insight into the specifics for how to do this in England and British markets. It's going to be a little different, but the same premise should apply. The same general rules should apply by and large.
Yeah.
So,
sorry
first thing
to interrupt
is
you, Christian.
No, go ahead.
Sorry to interrupt you there, but with us being in the British market and trying to invest in I'm just talking in the stock market. We do like right now more than ever. It's actually accessible to buy and deal in like US stocks and like even like Asia Pacific like shares. But obviously there are some tax rules that apply to the British population. So, for example, if I want to buy a stock in listed on the New York Stock Exchange, not in the London Stock Exchange, that will be I'll pay straight away like 15%. I think I'm not exactly sure of the number, but what I know for a fact is that when I get a dividend, for example, from an American company, it is taxed and it's like 15%. But the premise, the notion of actually getting into the stock market, the U.S. stock market, which is probably the biggest worldwide, it's pretty achievable. Thanks to retail investment apps like the likes of Robinhood. We have in parallel what I use is called free trade. So it's actually pretty accessible, which is
it's accessible, but it's not essential. You don't need to invest in the U.S. stock market to do and apply these exact same things we're going to talk about. Like you can do it investing in British companies or European Union countries, that kind of thing. So the premise will still apply, and it is still broadly applicable if you're investing in Asia, South America, wherever you're at.
Yeah. Buddy, do you invest in both the UK and here?
Actually, predominantly the majority of my portfolio is US based companies. So like I said off air, obviously I've managed since the start of this year, I started I made it, like Christian said, habitual, that every paycheck or like a month to month I would add and increase as much as I can the amount that I deposit into this investment account. So I started for example, I just stuck to the basics. So like companies that have amazing balance sheets and pillars of modern day economies like the Apples, and I started adding a bit, and the accessibility in doing so isn't just limited to the amount of shares that you, or the amount of companies that you can get into, but actually the fact that you can buy fractional shares. So when Tesla stock is $600 or whatever it was at the time, obviously it's quadrupled since then or whatever. It's skyrocketed. But you could buy that's what I mean, Mike. You could buy, and Christian could sort of highlight that as well. It's people really have no excuse right now aside from their inner fears and the myths that they hear about the stock market, and you totally should get into investing if you really want to achieve this. If you talk about compounded growth and passive income and just securing your future, I think it's available more than ever. When I started university, we didn't have these apps; they weren't available. You had apps that were we have an app here called Hargreaves Lansdowne, and it's you pay stupendous amount of money. It's £11 per share. So not per share, sorry, per transaction. If I were to make a transaction one day, we don't these apps right now. It's such a competitive market right now. That the fintechs and the companies that coming up, the Robinhoods and the free trades, and I think Webull in America, and we have Interactive Investor. These are amazing. They're amazing vehicles that allow people like us, millennials and people of our age bracket, to get into investing, without any.
Well, Mike said last time that his brother was into investing, and the problem is that a lot of folks that don't invest, the only experience that they have about with investing is usually a friend or a family member that makes it sound like this kind of real gimmicky thing. Like cryptocurrency or something, where it's kind of real gimmicky and stuff. It's not, right? Investing is simple. It's been around a very long time. It is how the vast majority of not only individuals, but businesses and institutions make their money. And an example, if you go to the bank, at any bank in any country, and you get a loan and they give you that money, what do you think that they are doing with money that people are depositing in their accounts, right? So like if you put your money into your bank account, like when you get paid, what happens to that money? Like it's not being stuck in a cash vault in that bank. And just like it's not. Now they do have cash, don't get me wrong. Every bank is actually required to keep a certain amount of cash in their vaults, but that's not where most of the money is, right? They're lending it out to other people. They're taking your money and they're giving it to other people on a loan. And that's how they make their money, right? Is that they take money from you and me that we give them. They lend it out to other people. They charge interest. They collect that interest. And that's how they make their money, right? And that is how every major institution in the world makes money as well. They're not just sitting on cash. They're reinvesting that cash. Universities, like in our case in the US, Harvard, Yale, Brown, Cornell, blah, blah, blah. For you guys in England, Brown and Oxford and all these super prestigious schools, what do you think they do with all that money they get from alumni? Right? They don't just sit on cash and they don't spend it immediately. They invest it, and they have endowments that are tens of millions of dollars that they've been investing for 200 years, 300 years, maybe more, especially over in England. So point is that this is a tried and true process trusted by a lot of people that has made more millionaires and more wealthy people than any other thing has ever done on the face of the earth ever. So when you're talking about investing, though, it needs to be more akin to brushing your teeth than it does to winning the lottery, right? Most people are not going to invest in the next Facebook and make $1 million overnight. It just doesn't work that way. Just like brushing your teeth really fucking hard is not going to make your teeth clean if you do it once a month. Like, doesn't matter how hard you brush, that's not going to do the trick. You got to brush your teeth every single day. So it's the same thing with investing. Like, you're not going to just hit it big with the next Facebook or the next Google. You need to invest a little bit every day for a very long time, right? The simple analogy is like, if I told you to choose, you could keep your teeth for the rest of your life. They'll never fall out. They'll never rot. You keep your teeth the rest of your life, or your teeth are going to rot and fall out, but I'll give you a Lamborghini today. Like, which one are you going to choose, right? Some people are going to choose the Lamborghini. And their teeth are going to fall out and they're going to be fucking miserable one day and they're going to hate themselves.
I won't be able to pick no nice girls with no teeth and then a Lamborghini.
That is correct. No more cheeseburgers, no more steaks. So
well, then you could sell your Lamborghini and then use the money to buy brand new teeth.
Maybe. Maybe. If your Lamborghini is worth anything by that point, since it's a depreciating asset. So anyway, without getting too far off topic here, it's a legitimate strategy that makes a lot of people a lot of money. Fatty, what you were talking about earlier with putting it into some like big household name companies, we call those blue chip stocks. Right. That name comes from, if you go play poker, your blue chip is your most valuable chip. It's the chip that costs the most. Right. And that's what a blue chip company is. They're big, huge companies. They're rock solid. They're not going anywhere. And they'll consistently give you payouts. So that's the Googles, the Apples, the Amazons, the Coca-Colas of the world. Right. Now, one of the other things you were talking about, and this was the last thing I wanted to touch on before we start getting into more specifics on getting started, is you talked about being able to buy stocks of companies like Tesla, for example, that are super expensive, $500, $600 a share, right? And you can do partial shares. Well, you can do that, but a good example is Tesla. Tesla just had a stock split. I think 2 weeks ago, maybe 3 weeks ago, something like that.
They did.
And the point of that is that they take the share that is worth $500, for example, and they'll split it 5 to 1. So now the share is only worth $100. But they're going to give you 5 of it. So you still have the same amount, but the share price is way lower, which makes it possible for us. Well, part of it's a marketing strategy, but part of it's also that they just want to make their investments available to everyday people. Not everybody can spend $500 on a single share, but most people can afford to put in $50 or $75 or $100. So they reduce the price of the share, and it allows people to get in. It removes a barrier to entry. So let's get on the topic here as far as how to get started, because that's going to be really important for everybody. So for most people, the easiest way to get started is going to be through their job. Now, I say for most people because that's not every company will give you an opportunity to invest. But most companies will offer you some type of 401k or some other type of account, retirement account that you can invest in. And that's usually going to be your easiest way to get started because they make it very simple. So if you got it through your company, go through your company, start that process. They'll walk you through how to do it. If you do not have a employer plan that you can use through your company, the next best thing is going to be to go start your own retirement account. You can do it with any bank, any major, Barclays. I'm sure you could go start an IRA. Credit Suisse, you could start an IRA. Here in the United States, Fidelity, Vanguard, BlackRock is international, I think. You could start an IRA with BlackRock. So lots and lots of companies. If you just Googled, individual retirement account, you'll get a dozen companies that pop up that you could start with. And then you just start putting the money in. That's all there is to it. You link your bank account to it and you just put some money in, and then you can start buying stuff. And
is there like a good rule of thumb, like when you're first starting out, like how much you should put in each start off?
Yeah, the benchmark would be 15%. Now that's a lot, and not everyone can afford to do that. I don't do that much, but my company puts some in. It makes it up for me.
Right.
So I put in about 10% of my paycheck, and then my company matches it, and they put some of the money in too. So 15% between you and your company combined. But if your company doesn't do it, just whatever you can afford.
Right.
So now again, Fatty, some of this stuff's a little bit different for you guys, but I know you guys do have employer plans.
Yeah, we have
we have
like a pension scheme, they call it. So like
so I started doing some research on that when you and I last talked. And England, and Mike, I'm curious your thoughts on this. So England made an actual law through Parliament that if you work for a company that has a retirement plan that they offer to the company, that they automatically enroll you in it. Automatically, you have to do it. And the only way you can get out of it is you have to actually
opt out.
Tell them, I don't want to do it. And you have to fill out paperwork and tell them you don't want to.
Right.
So for someone like you that's kind of new to this, that hasn't really started investing, if you just started at your new job, would you prefer them to go ahead and just make you start doing it and put in 3 or 4% of your paycheck, or would that bother you?
I think, I think if I knew about it and
they would tell you. They have to.
So
they would say, hey, Mike, we've got this savings program for our employees where you put in 3% of your paycheck. We're going to put in 3% for you. And we're going to go ahead and start you on it. And if you don't want to do it, you have to fill out this paperwork and tell us you don't want it.
Yeah. I think it'd be pretty cool. I would go along with it and let it just ride out and see what happens. And then if I ended up not liking it or whatnot, I would.
So that's,
of course, but
that is how most people would respond. Right. Which is pretty cool. I mean, why not? Yeah. Seems all right. It's not that much. I could do 3% of my paycheck. So that's what people in England did. And when they started it, it was 3%. And they actually ramped it all the way up. And I can't remember the exact number. And maybe you can tell me, Fatty, but I read in the article I was reading, I think it's 10% now or something like that.
I think 10 is the basic. With Barclays, I have a really good, scheme where they, I think it's 10% as sort of the entry level percentage. And then you can actually, I think up to 70% of your salary, if you wish to, you can contribute that much. And they
which for most people is unrealistic, but 10% is not. 10% is not that bad. Yeah. So if every, go ahead.
Right. I was going to ask Fadi a question, but Fadi, so do you have 2 separate investing accounts, I guess they're called? Just one through your company and then one through the app?
Yeah, so the one through my company is actually by a third party. I don't know
Okay.
what how you label him. It's like a BlackRock, but on a smaller scale. It's not BlackRock, but it's like a fund management company that actually will take that 10% or whatever amount that is, and will reinvest it. And I think you have to be at a certain age to be able to withdraw that money or to be able to see the yields on your investment over the years. Whereas the other account that I talked about prior to starting the podcast was an account with free trade. So free trade is like a fintech. It's like an online brokerage account where you can actually purchase shares like at your own wish.
A third party not connected to your job. Right?
Not connected to the job at all. No.
Yeah. Okay.
Gotcha.
Yeah, and that's pretty common, right? We have the same thing in the U.S., right? No different at all. You can do it through your company. You can do it on your own. I usually suggest doing it through the company as much as you can, just because it's simpler. It's easier to keep track of.
Yeah.
The rules are a little bit less complex because they kind of dumb it down for you a little bit. You know, they make it dummy proof. So that's what I would tell people. Start through your company. And then if your company doesn't give you that option, then you can look into some, in the United States, what we would call an IRA, an individual retirement account. I don't know what the equivalent of that would be in Britain, but I'm sure they have a similar offering.
Yeah, I think that's the pension scheme, Christian. This is what they call, the pension plan.
Yeah.
Work.
Yeah. So in both cases, it's easy to get started through most people's jobs. It's becoming less and less common for a company to not offer you some type of 401k. Like I worked at a restaurant as a waiter, and they gave me a 401k.
Wow.
Yeah. So, I mean, it's super uncommon unless you work for like a really, really small company to not be able to get a 401k.
Right.
So as far as how you get started, start through the company. The goal would be 15% between you and your company combined. If you can't start out that way, that's fine, but just do as much as you can. And that's kind of the goal you want to shoot for is 15%. Now, the next thing would be, all right, so you get started, what do I invest in? Right? Like that's the big question, right? What do I put my money into? So that kind of brings us to the second point I wrote down here, which was types of investments. So on the highest level, there's four types of investments. You have stocks, you have bonds, then you have cash, or what we'd call like cash equivalents, and then you have alternatives. Now, alternatives would be like real estate or cryptocurrency. Anything that's just not like a normal, regular, like investing in gold, right? That's an alternative. So let's quickly outline what those actually are, right? So can you guys tell me what a stock is? Like just from your own education, what you've learned, do you guys know what a stock is?
I feel like I do, but I just can't put it to words.
Sure.
If that makes sense.
What about you, Fatty? I know you've been buying some stock. Can you tell me what stock is?
This will sound like a very naive answer because I'm not like I can't give you like the articulate meaning of what a stock is.
I'm not looking for that. Just in your own words.
I know that when I buy a stock or a share in a company, then in a way I do own. I'm a shareholder, so I own part of that company.
Exactly.
Although intangible, but I do sort of like have a share. I'm sure you have a more in-depth meaning, Christian. So
no, stock is ownership.
Yeah.
Period. That's my definition of stock. It's ownership of the company. Now, it could be very, very small ownership, like you own 0.0000001% of the company, but you own part of it, right? That's why you guys have probably heard this term, publicly traded, right? A publicly traded company, right? That's Google and Apple and Amazon and all these big companies, right? They are owned by the public. Bill Gates is not the owner of Microsoft. Jeff Bezos is
Gotcha.
not the owner of Amazon.
They're the founders.
Mhm.
Though.
They're founders.
Yeah.
And a lot of times they might be CEOs or presidents or something
And
like
have
that.
a big share though, and I think they do have big shares.
And yeah, and most of them will have a big ownership. Like Jeff Bezos has got a massive amount of Amazon stock, right? Massive amount. And that's where most of his money is wrapped up.
Yeah.
But he's not like the sole owner. It's not like if you guys went out and you started your own business, you know, doing whatever, cutting lawns. Like you're the only owner of that company. Nobody else owns it. Publicly traded company is not like that. It's owned by the public. Now, every single time you buy a share, you own more of the company. So what does that mean? If the company is doing well and they're making a lot of money, then as the owner, you make money because you own them and they're doing well. So you make money. And vice versa. If the company doesn't do very well because they make poor decisions or the economy gets really bad, well, then you as the owner, just like if it was your own lawn care company that you owned and you're mowing lawns, if your revenues go down, you as the owner lose money. You make less, right? Super simple. Stock is just ownership. Small piece of ownership in the company, right? Now, this is the one that everyone, you know, knows about. This is the one that's got, you know, that most folks have heard of, the stock market. And it's the one that can make you a lot of money. And it's the one that you guys and myself and anybody else that's in our age group should be investing in.
Yep.
Almost exclusive right now. That'll change later. But for right now, that's all you need to be investing in. Now, the next piece of that would be, so if you've got kind of three, you know, think of it like we got like a graph, right, or a chart. At the top of the chart, you've got stock, bonds, cash, right? Well, now we're going to go down, and there's kind of separate little families within stock, right? So you've got mutual funds, and you've got individual stock, right? Now, there's, again, a lot more to it, but here in the United States, at least, most of what we would want to be investing in is mutual funds. A mutual fund is simply a big basket full of a bunch of different stocks from different companies. That's all it is. So when you buy a share of that mutual fund, you actually end up buying a little bit of like 30, 40, 50, 100 different companies all at one time, just by making one purchase. Right? It's like a bundle deal. And the reason that's better than stock by itself is because if you're just in stock and that company that you're in does badly and all your eggs are wrapped up in that company, you're going to lose a lot of money. But if you spread it out and you own 100 different companies, if one of your companies does bad, it doesn't really hurt you that badly.
Quick question,
Right.
Christian. When you say mutual fund, is it the same as exchange traded fund, like an ETF? They call it?
Very
Is
good
that
question.
exactly the same?
They're not. They're very similar, but they're not exactly the same. And that is kind of considered, and I wasn't going to get too far into that just because that's a little bit more complex, but ETFs are another type of investment you can buy that it'll buy you stocks, but just like a mutual fund, you'll get multiple companies of stocks inside that one share of your ETF.
Right.
So it's, you know, for the sake of our conversation today, I'll just say it's not the same, but it's very, very similar.
Perfect. Yeah.
Now, the next investment, and I won't spend a lot of time on this because we don't really need to talk much about it, would be bonds. But it is important to understand at least what they are. So just like there's a very simple definition for stock, it's ownership in the company, right? A bond is debt, right? It's debt. So you basically lend a company your money, right? You're the way we look at it is you're buying their debt, right? So let's say ABC company is wanting to expand and they want to build a new building, and it's going to cost them, you know, $50 million to build that new building and do all the stuff that they need to make it, right?
Yeah.
They don't have $50 million in cash because they put their money to use in other places, right? So what do? They issue a bond. They go out to the public. They ask the public to give them money, and they raise $50 million. And in return for the public giving them that money, they say, okay, every single month on this day of the month, we're going to pay you a little bit of interest. We're going to pay you 3% of whatever you gave us. Most bonds are worth $1,000. So you give the company $1,000. They pay you 3% of that every single month for the life of the bond, which is determined up front. It could be a year. It could be 3 years, 5 years, any number of time. So for that time period, they pay you 3% of whatever you gave them every single month till the end of the life of that bond. And then at the end, if you don't get rid of the bond, if you keep it, they give you all your money back that you gave them in the first place. So you gave them $1,000. They've been giving you $30 every single month for the last 2 years. And then they give you back your $1,000 as well.
So you can't really lose in that situation, can you? Or is it?
That's the idea. That's the idea. Now, again, I won't get into this too far today, but there are ways you can lose. There's always ways you can lose in an investment. But it's way harder to lose than stock, right? And if you think about that, or the way we just explained it, the losses you could have in stock are unlimited. Like you could lose everything, right? In a bond, that's not really going to happen.
Mm-hmm.
You know, the only way that happens is if the company goes belly up and they fail, right? And they can't pay their debts. Well, then the government tells them they have to sell everything that they own, and they have to use the money from what they sold to pay you. Mm. So even then, it's still hard to lose money on a bond. So the idea there is bonds are going to be safer, but they're not going to pay you as much. You know, you might get 2%, 3%, whereas in the stock market, you might get 10%, 12%, 15%. So there's a trade-off. You're trading safety for a lower return.
Yeah.
Right? That's the idea. That's why we don't really need to be investing in bonds right now. Because, Mike, if you start investing and you put away 10 grand and then the stock market drops and your value goes down to 8 grand, who cares? It'll come back up in like 6 months and you'll get all your money back. Right. So why does it matter? You know, you just write it out and you just let it come back.
That's what happened actually, Christian. That's a nice something that resonates with me. When I first started in January and everything, all the stocks went down in March. It was like Black Friday for people to buy, you know, people getting into the stock market at the time. Unfortunately, I didn't have the capital to sort of like do this. And I want you to explain what this means, all this dollar cost averaging, you know. I didn't have the money to go in and add into to sort of like listen the losses. But what I did, like what you just said, I just wrote it out. This is for me something that is going to be untouched for like the long term, for the next 5-10 years. So that's a really good piece of advice to anyone like starting, you know.
That's right. So let's talk about dollar cost averaging. Super important, right? So it's a complicated sounding term that means something very simple. Dollar cost averaging simply means that you put a little bit of money into the stock market on a regular basis. So like every paycheck, for example.
Yep.
Right? As opposed to the idea of taking like a whole bunch of money and dropping it all in at one time. So let's say you get $50,000 you save up in your bank account, and then all at once you take all $50,000 and you put it in the stock market all at once. That's not advisable. And the reason is the stock market might not be favorable for you to put all that money in right now.
Yeah.
Right? Like if the stock market is super high, like let's say the stock market is like through the roof. Everybody's making money. Everybody's loving it. Maybe you're up 20% on the year. It's awesome. Right? If you didn't already own the stock, that's a terrible time to go buy it. Yeah. Right? Because it's reaching its peak. Like it can't go on forever. Eventually, it's going to get too high and it's going to stop going up. And then it's going to actually start to go down. And if you try to buy it when it's way up here, one, it's expensive as hell. So you're buying a stock that maybe 6 months ago was worth $25 and now it's worth $60, right? So it's super expensive and you run the risk that it's going to turn around and you're going to lose it all in a month.
But could you time the market, Christian? Can anyone really time the market?
So it's popular to think no, but the honest truth is yes. if you are really, really, really good at it and you've spent tons of hours on it. Yeah. So for us, the answer is no.
Yeah.
We should never be trying to time the market. What we mean by that, by the way, Mike, if you're not familiar with that expression, timing the market would mean trying to like figure out when it's going to be at like a good point to try to buy in or try to sell out. Right?
Yeah.
Super risky.
I thought that's what it meant. Yeah.
Yeah. Super risky because we don't know what's going to happen. The stock market could just blow up tomorrow and everything could drop 25% for seemingly no real reason. Mm-hmm. But on the other hand, it could also shoot through the roof tomorrow for no real reason. Right. So timing the market's a very bad idea. However, there are certain people who do this for a living, who keep track of it every single day. They've been keeping track of it every single day for 20 years, and they're extraordinarily good at what they do, who can do that. And those are usually people who manage big portfolios of investments and have been doing it for
Warren
2
Buffett.
decades.
Yep.
Warren Buffett, you know, a guy like that. So those people exist, and it's possible to do it, but it's extremely difficult. It'd be like telling one of us to go build a rocket ship. Like, it's just, are there people who can build a rocket ship? Yeah, sure. But we're not one of those people.
Mm-hmm.
Not a chance. So it's the same idea.
Yeah, I got you.
Now, dollar cost averaging, super beneficial because it's easy. And the other reason it's really good is, let's say you put away $300 every single paycheck, right?
Yeah.
And let's say this week the stock market has been doing very, very good and it's super high, so investments are expensive. And you only put in $300. Well, you're not going to buy that much stock with only $300 when everything is expensive. But that's actually good for you, right? Because just like we talked about, you don't want to buy it when it's really expensive. The alternative then is, let's say a month from now, you get $300 more you put in, but the stock market is really low. Well, that's a good time to be buying it because you're buying everything cheap, and that same $300 is going to get you more shares because they don't cost as much. Mm-hmm. And if you can buy more shares at a cheaper price, I mean, they're going to come up in value, and you can sell them one day and make a lot more money.
All right.
Yeah. Right. Now, if you just dropped in $50,000 all at once, that's a lot harder to do because if you pick a bad day, you could shoot yourself in the foot.
Mm-hmm.
But what about, Christian? I wanted to ask you actually. What about people like myself, for example? I don't envisage selling most of my 90% of my stuff. Like, obviously, it's my portfolio that I'm trying to build and put together right now is going to comprise of both dividend growth and stock growth investing. But what about people that actually want to make a passive income that, say, hypothetically speaking, in 10 years time, I don't have to work a day job. For example, if I really aggressively, and continue dollar cost averaging from here to the next 10 years in the companies that you said that we highlighted before, the pillars of the economy, and get that dividend, which is likely to increase with these companies, when you look at the future dividend outlook. So what about that? Like, is that a good strategy, or what would you go for, or what would you do? Pros and cons to each.
I'm going to keep this high level, Fatty, because that's a very specific question and probably one that we should talk a little bit more about off the air, so to speak. But I'll answer it at least high level.
Yeah.
So some of this stuff, Mike, might sound foreign to you if this isn't really stuff that you're interested in. So here's the idea. Some companies pay a dividend. A dividend is profits that the company made that year, and they're going to give it to their shareholders, right? Mm-hmm. So again, let's dumb this down. You run your own landscape company or your own lawn care company, mm-hmm. and you have profits, right? What happens to those profits? They go right to your pocket, and you can do whatever you want with it. You can buy a new lawnmower with it and hire an employee, or you could spend it on toys and have fun, right? Mm. So if you are an owner of a company, you own stock, so you're an owner, and the company is profitable, they've got a couple choices for what they can do with that profit. So when a company decides to pay a dividend, that's them saying, we're going to give this profit to the owners to go spend it on whatever the hell they want. They can go buy toys with it. They can do whatever. Yeah. That's the idea. So what Fatty is asking is some people will buy a lot of stock of companies that pay those dividends.
Mm-hmm.
And if they buy enough of it, they can actually have enough dividends being sent to them that they can pay their bills and they don't have to work.
Yeah.
Right? You can just live off of the dividends that your shares are producing for you.
Mm-hmm.
So that's the question he's asking is that a good strategy? Is it feasible? Is it realistic? And the short answer to that, Fatty, is not terribly. It's not a terribly good strategy. Now, there are ways to use it to supplement other things that you're doing, but by itself, in order to have enough dividends to pay all your living expenses,
Need a lot.
you would have to
invested.
own a shit ton of stock,
Millions.
worth a lot of money,
Yeah.
probably like well into the hundreds of thousands of dollars, maybe even higher.
Yeah.
And remember what we talked about earlier, it's not good to have all that money wrapped up in one company, because if that company tumbles, even if they're a well-known successful company like Google, it can happen.
Yeah.
There are horror stories that you can look up. I won't go into all of them with you guys, but
You could have bad days. Yeah.
do you guys remember Nokia, the phone company?
Yeah, Nokia. Yeah, definitely.
Okay.
Yeah.
Nokia is one of my
before
first phones. I had one of those blue
Same.
brick phones
Yeah,
from Nokia. Yeah. So if you go back, I think the year was 2006. Nokia was the largest company on the New York Stock Exchange. It was the most heavily traded stock on the New York Stock Exchange. It was massive. Where's Nokia today?
They're still around, but
Not
obviously
around.
nowhere near as big as they were.
Yeah. I mean,
Yeah.
they were the biggest stock on the stock exchange. Like, they were the top dog. They were like Amazon.
Wow.
And they're gone. Like, you don't see anything about Nokia now.
Nothing's for certain. Yeah.
And that's the problem, right? So if you wrap up a ton of your money, enough money that those dividends could actually pay all your bills for you, you'd be having to wrap it up into one company or maybe two or three companies. And there's nothing promised with those companies. The other issue with it is that those profits that they're giving you, those profits could dry up.
Yeah, they could cut
Right?
them. They're not promised the dividends.
That's right. They're not promised.
Yeah.
So they could either lose their dividends because COVID happens.
I
And
think
all their
Wells
revenues
Fargo
dry
did that,
up.
Christian, didn't they? Wells Fargo, the bank, they cut their dividend, or they
A lot of
completely.
companies.
Yeah.
A lot of companies did, because there's no more profits. Like, you don't have anything else to pay a dividend with.
And
You know?
General Electric, I've heard as well, because I thought about investing in them, and I think they were.
So full disclosure, I have owned General Electric stock.
Yeah.
General Electric for a long time in the United States was like a huge
monopoly.
household name.
Yeah.
Everybody knew General Electric. Like, that's the place your grandpa went and worked for 40 years and got a pension. Like, everyone knew General Electric.
Yeah.
And General Electric is barely hanging on for dear life right now. Like, they've been selling off parts of their company left and right because they can't survive, and they might not last another 10 years. They might be completely gone in 10 years.
Wow.
So again, that happens, right? It happens.
It's a scary thought when you put everything, like all your blood, sweat, and tears into one, like a few selective companies, and you know, that's
why you don't do it.
Yeah, and no, but what about people that actually diversify? That look at I mean, I'm not focused into. I'm not gonna like put like 10 grand into Apple or like 10 grand into Johnson and Johnson. Although, I mean, their future outlook, like you said, nothing is guaranteed, but these are once in a lifetime companies still. But I'm not of that mindset because to me, as someone who's not sort of like avidly, I'm not a veteran investor. I'm not, you know, I'm only just still getting into it. And I think diversification is key. So I look at, for example, industrials, consumer goods, you know, renewable energy, commodities, like you said. I've not looked at bonds, but it's a safer alternative. You know what I mean? It's nothing, you know, off the table. But what about people that actually diversify and not focus into like putting all their eggs into one basket?
So, two things I would tell you, Fatty. For somebody like Mike, for example, that's new to investing and would want to kind of get started, get his feet wet. what you're talking about is overwhelming. That's just too much. Like there's so much of that stuff that they would have to try to figure out. It's overwhelming.
Yeah.
So what I would tell someone like Mike or anybody who listens to the podcast or anything else, if you want to start investing and get in and start getting into it, don't worry about all that other stuff. Now, for people like you, Fatty, that are just interested in it, you and I could talk about that for hours. And there's tons of information we could discuss. But for someone that's new, that just wants their money to grow a little bit and they just want to kind of get it going and they don't want to have to do all that research themselves.
Yeah.
All you need to do is put your money into, now, before I say this, let me go ahead and put this out there as a disclaimer, as a disclosure.
We need that disclaimer.
I'm a professional in this industry. I'm not allowed to make recommendations on individual stocks, or I should say rather I avoid doing it. So this is not me giving a specific recommendation. This is simply me giving generic advice.
This is for entertainment purposes only.
That's right. Entertainment purposes only, right?
Yeah.
This is not applicable to your individual situation.
Yeah.
But broadly speaking, what I would do if I were someone like you, Mike, is take that money from your paycheck and put it in what's called an index fund. It's a type of mutual fund. Right? Remember we talked about mutual funds earlier. You buy one share, and inside of that one share you buy is 100 different companies. Right? Yeah. I would just go buy an index fund of the S&P 500. Now, all the S&P 500 is a list of the 500 biggest companies in the United States that are publicly traded. Right. That's all it is. So when you buy a share of an S&P 500 index fund, you are basically buying a little piece of the 500 biggest companies in the country. And that will give you, time has proven, that will grow your money roughly 10 to 11% over time. And that is more than enough. Now, again, we can get into more specifics later on about there are ways to get even more growth than that on a pretty regular basis. But that's a little bit more advanced conversation. So if someone wanted to get started today, and this is kind of what we're gearing this conversation around, was beginners, right? Someone that's young in their 20s, kind of getting started. All you'd want to do is put it into like an S&P 500, just drop it into any kind of stock. Frankly, even if you just bought one company, I won't advise that, but even that would be fine. Just put it in there and let it sit and don't touch it and just keep adding to it over time. Now, for somebody like you, Fatty, that's a little bit more interested in some of the details, we could get into some of that more. Because again, there's a massive rabbit hole we could go down with this stuff.
I don't think this is going to be the last episode, by the way. This is obviously, this is going to be a mini series of the podcast.
Mini series, yeah.
And some of this too, we can talk about off camera. And we could even potentially, like you guys said, do like a little spin-off where you guys can keep talking to other people about other topics. Yeah. But we can bring this up every so often just to talk about some specific stuff.
Quite reasonable.
But there's a lot that we could talk about on this topic that can go on and we can get really deep in the weeds. And I don't want to get anybody too overwhelmed that's listening or frankly just us in this conversation right now. So to bring us onto the agenda here. So investment types, stocks and bonds are your two most common. You do have some others, but we're not going to really spend time on those today because they're not important for the sake of this conversation. How to get started: start through your company if they offer you an option to do so. If they do not, here in the United States, you can open up an IRA, an individual retirement account. And it does pretty much the same thing as a company plan would do, but you don't have to do it through your company. You just do it by yourself.
We call it an ISA here in the UK. It's short for, I think, investment, I don't know.
Like investment savings account or something?
Something along those lines. We have like different types of it as well. So ISA.
Yeah, look it up.
Individual savings account. So it's a scheme allowing individuals to hold cash, shares, and unit trusts free of tax on dividends, interest, and capital gains.
There you go.
Yeah, so this is the equivalent of the IRA. So it's an ISA.
There you go. Yeah. So perfect example. right? So a little different name, but does the same thing. But if you can't go through your company, go through an IRA or an ISA, an ISA, and start saving that way. Where do I start? The easiest place to start, if you don't know anything about stocks and you're maybe learning a little, but right now you don't know anything, you just want to start, is just put it in an index fund that follows the 500 biggest companies in the country. And in the case of in England, I bet you, I don't know this, but I bet you there is a similar type of investment that will put you in the 500 biggest companies on the London Stock Exchange.
Yeah, it's called the FTSE. The FTSE.
The FTSE, yeah,
Yeah,
the FTSE.
yeah.
Yeah, the FTSE is basically the equivalent of the New York Stock
Let
Exchange.
me bring it up. I'm just gonna bring it up on free.
But in
trade.
England.
So it's
Now, while Fatty pulls that up,
so we
we
have the
can kind of
FTSE
burst.
100.
Yep, there you go. So that's going to be like the 100 biggest companies in the British economy or in the English economy, basically.
Yeah.
And it's an easy way to get you good exposure to a lot of big companies that are going to do pretty well. They're going to make your money grow fairly well. It'll be somewhat volatile. Yeah, there's your little trend line, right? You can see the lines going up and down. So it's going to be a little volatile, meaning that you're going to see some ups and some downs. But for us at our age, that's what we want. Because volatility is good for long-term growth.
Yep.
So, and that's what we're shooting for, right? We want to grow this money as much as possible.
Yeah.
Now, the last thing that was on our list here is kind of strategies, right?
Yeah.
So let's say you get into the market, you've started your company plan, or you've started your IRA, you've put a few $100 in each paycheck, got a few $1,000 put away, and you've been putting it into a index fund like the FTSE or the S&P, and it's been growing and it's doing pretty good, right? Now you start thinking, all right, I'm starting to get the hang of this. I think I want to figure out some ways to make this money to grow even more, right? Or maybe I'm looking for something specific, like Fatty was saying, I want something that will pay me dividends so I can use this to help pay my rent or whatever. Fill in the blank. There's lots of different objectives you might
Go
have.
to a holiday, or buy a
Yeah,
new
or
car.
maybe I want to invest in companies that I think are, have green futures, meaning like, they're very eco-friendly, right? They align with my personal beliefs for what I think is important for companies and how they should behave, right? They're ethical and they've got, green ideals for their company. So now you can start narrowing your interest into specific strategies into specific places. And again, there are a lot of different ways to do this. But the one that I'm going to talk about today that's most important for our conversation is growth investments, right? So this would mean you're investing in companies specifically that have growth potential, big growth potential. Now, as we talked about earlier, the FTSE and the S&P 500, biggest companies in the country, right? How much room for growth does a company like Johnson & Johnson really have?
Yeah.
Johnson & Johnson makes toilet paper, toothpaste, stuff like that, right? Probably not a ton of growth, right? Yeah. I mean, they're already so huge. They're going to grow a little bit each year, but they're not going to like explode overnight. That's just not going to happen, right?
Right.
But for us, young investors that have a lot of time in front of us and we want a lot of growth, there are certain companies we can go out there and target that are growing really, really fast. So when they get those profits, for example, they're not paying dividends to their shareholders. They're not giving the profits away to their owners. They're putting it back into the company so that they can grow and they can hire more people and they can make more revenues and they can make more profits, right? That's the idea. So you can get to the point where you actually start to invest in companies only and specifically that are geared around the idea of them growing. Now that would be examples would be like Amazon, right? Amazon is actively trying to grow. Like that is that they are trying to grow as fast as possible.
They're huge already, though. I'm just trying to think. They're gonna what are they gonna go into like now? Like they're already everywhere. Like,
well, they're going to continue to scale, right? They're going to continue to build. They're going to continue to enter into other industries, right? Groceries, they started entering into the grocery industry. Clothing, they're going to start entering into the clothing industry, right? They're going to keep expanding and growing. and they
It's
have
endless.
plans to do so. Yeah, they're going to take over the world, but that's a whole other
pretty
conversation. But, you know, companies like that, or companies like, you know, who's another good example? Maybe some of these big software companies, you know, that have, that are, you know, on the cutting edge of software development for iPhones and Androids, right? That they're out in like Silicon Valley. They're big, they're household names, companies you might know, but they have a lot of growth potential. Yeah. So those are the types of companies that I am investing in, and that I would encourage most people who want to take an interest in growing their money more aggressively to look into, because they will grow more than 10 to 11% over time, a lot more.
Right.
Now, that doesn't mean every single year they're going to do that. There's going to be years where they lose 10%, and you're going to end the year having lost 10% of your money, and that's going to happen. But then next year they're going to grow by 25%.
Yeah.
And the year after that, they're going to grow by 17, and they're going to lose 8%, but then they're going to grow by another 12 or another 16. And that's what happens, right? It's like this, right? They're going up and down, but they're trending up.
Yeah.
Like this, right?
Yeah.
And that's the idea here. And that's where I would start telling people like you guys, as if you start to get more interested, that's where you need to be looking. And I would encourage you to not do it through individual companies, not going out and buying Tesla stock, but buying a mutual fund that has 200 pre-selected companies that have already been researched by professionals to be, you know, to have a lot of growth potential.
Yeah.
And invest in a mutual fund or an ETF or something along those lines.
Right.
Right.
This is the safe sort of
so
like.
you can narrow this down into any niche.
Yeah.
Yes. I would hesitate to call it safe because it is volatile, right? Your money. There are going to be times you lose money.
Safer than picking individual stocks, though, isn't it?
Definitely safer than picking individual stocks, because that's so difficult to know what the future of that company will be in 3 to 5 years, unless you are diving super deep into like their numbers. And not everybody wants to do that. Frankly, I don't want to do that. I don't like that. It's boring as hell to me.
Yeah. I don't do that. I go off, which is not, it's not probably the smartest thing to do. I go off by the scale of operation and the reputation, you know.
That's part of it. I mean, there's more to it than that, but that is part of what determines how successful a company is going to be, right? Yeah. So, like a good example of this is Tesla. So Tesla, I don't know if you guys have, if you know anything about Tesla, but they haven't made profits in almost their entire history of their company, ever.
Yeah, really? It's just the hype.
They've almost never made a profit.
Although they skyrocketed. Like if I share with you guys, obviously.
Yeah. Pull up the Tesla stock price. It's kind of absurd.
Look at me and Andrew's my friend here in the UK. We were just like, because both of us got into investing like early in the year, and we didn't get into Tesla until the massive shift like early in the year, when it was just like boom, like at one point it like 200% increase or like 300% increase. But look at and then we were like contemplating, we're like, oh, we could have retired if we put this X amount of money. We could have like made 300 grand or like 200 grand here. But look at this line here. Look at how look at that. This is one stock on steroids, literally.
Yeah.
Look at the increase over the last 5 years.
I have a friend that works for them, and they were giving him shares as like part of a company benefit, and they like quintupled since he started working there.
Unreal.
Yeah. So okay, so here's a good point. Let's dig into this a little bit here. So as for people who are new to investing, they're going to be looking for that, because that's sexy, right? That's cool. That's what everyone wants to be a part of.
Yeah.
Right. Yeah. Quick wins. Here's the danger in this. If the company has already had that kind of a movement, and you're like, wow, that's incredible, like I'm going to get in on that, you already missed the boat. Yeah. The boat has sailed right on past you. Yeah. Now all you're going to do is buy them at a way overinflated price.
Yeah, and lose.
And in a few months, that they're going to come to a screeching halt. And all of a sudden, it's going to go like this, and then it's go, and it's going to just take a shit. And you're not only did you buy it when it was more expensive than all those other people bought it before that big jump happened, but now you lose it all too. So you spent more and you lost it all. At least the people who lost it all that bought it cheap bought it really cheap, right? Yeah. So they didn't actually spend that much.
You're talking 10 years ago. You're talking like people that actually start investing in Tesla 10 years ago. Wow.
Well, I mean, there's varying degrees of this, right? Yeah. If you were what we call an angel investor is like an OG original investor in a company. So like, for example, the OG angel investors that started Twitter are multimillionaires, all of them, right? Wow. Same thing for the ones who like Google made more millionaires, or excuse me, Microsoft. I apologize. Microsoft made more millionaires when it went public than any other company in history. Because they had people that were angel investors who'd given $100,000, $500,000, $5 million to Microsoft when they were starting. And then when they went public and they exploded, all those people became millionaires instantly. Instantly became millionaires.
The dream.
Yeah. So it's the dream, but what you don't hear is all the times that those guys put money into other companies like that went bust and they lost $500K, right? You don't hear about that. So that's the risk you run. Like a lot of people will want to invest in what are called IPOs, initial public offerings. That's when a company that's private, that's owned by like 2 or 3 people or one person, wants to go public and become owned by the public, right? So like Twitter did that, or Snapchat did that, like a year ago, right? You guys probably heard about that in the news. So Snapchat went public is the expression.
Initial public offering, is it? The IPO.
That's right. And you can buy shares of an IPO. And it's very, very risky because Snapchat, as an example, everyone was hyping up Snapchat, thought it was going to be incredible. And they lost a shit ton of money when they went public. Like everyone was like,
it's a very stagnant. It's a very stagnant stock, Snapchat, right now. Like no one really talks about Snapchat, like amongst the investors.
It was all the hype when they were starting, and then it just plummeted, and it never really recovered from that. So IPO investing is similar to angel investing. It's not quite as early on, but it carries that same risk of if this shoots through the roof, I can really make a lot of money. Like there's a company, I don't know if you guys have heard of them, called Beyond Meat. They make
heard of them, like vegan.
They make they make like vegetarian and vegan stuff. And they went public last year, and it was absurd, dude. They were up like 120%. In like the first week.
I thought I invested in them actually, literally the other day. I read an article.
For the people who invested in them when they went public, I mean, they made just an absurd amount of money.
This is their increase over the last month. So they
take that back to when they first started. To go back to like 2 years ago or a year ago.
2 years ago. So they went public on the 2nd of May 2019. And they were at $65 a share. Right now, they're $194 a share.
Yeah. There you go.
Wow.
Proper nice.
I'm not vegan, but I wish I'd invested in them.
I know, right? Well, and that's the complicated thing, though, is like everyone heard of Snapchat, and everyone would have thought the Snapchat was going to do great, and it didn't. Nobody knew who the hell Beyond Meat was, and they exploded, right? Yeah. So that's why that's so difficult to do. Because it's just so like, unless you're neck deep in that kind of like world, like we would call that venture capital, where you're like out there lending money to startups. Unless you're like real neck deep in that and you know everything about it, you don't know anything about a company like Beyond Meat. Like no one would ever heard of them, you know? So that's the hard thing to know. But to wrap this up, because I know we're coming up on time.
Yep.
Most important thing for a new investor to remember that we haven't already covered is be consistent. It's like brushing your teeth, right? You do it every day. If you want to keep
Habitual,
your
like you
teeth, you
said
don't do
last
it.
episode, Christian. The habit.
That's right.
Yeah.
That's right. You
Yeah.
make it habitual. You don't do it once a month really fucking hard and hope that your teeth are going to be clean. Okay.
Yeah.
So you be consistent. When the stock market does badly, because it's going to happen, don't touch your money. Do not touch your money.
Don't panic sell.
If I could put this in all capital letters with asterisks and exclamation points, do not touch your money.
Yeah.
Now, this is why I tell people not to invest in individual stock. Because if you invest in individual stock and you listen to me and you don't touch your money, you could actually lose it all.
Yeah.
Right? You could lose every penny and never get it back. Because there's no guarantee that that company is going to survive. Companies fail all the time.
Yeah.
Okay? But if you invest in the FTSE, what are the odds that the 100 biggest companies in Britain are going to all fail at the same time?
Very minimal.
It's not gonna happen. The only way that would happen is if the world ended.
Yeah.
So
Or the S&P 500. I prefer
exactly.
that, actually,
So be consistent. Put it in consistently. Don't take it out just because it's doing badly, because it will come back. And if you're in your 20s or 30s, or frankly, even if you're in your 40s, you still have so much time ahead of you before you're going to use this money that it will come back and you'll make everything back.
Mm-hmm.
Okay. And then third thing I would tell people is, well, really just kind of a combination of those two things. Be consistent. Don't expect overnight results. Do it for a long time. And that's the part that people have the hardest time with, right? They want instant gratification. They want a quick hit. They want to make that money tomorrow. That's not how this works. You do this every day for 30 years. And I promise you, like I will put my neck out there. I promise you, if you do this every paycheck for 30 years, you will be a multi-millionaire. Like I literally, I will put my hand on the Bible. If you do this and you listen to me and you don't take your money out, you will be a multi-millionaire if you give it 25, 30 years. So the question is, people feel like that's so far away, but think about your parents, right? How many of our parents are millionaires?
Yeah.
My parents sure as hell aren't,
Mm-mm.
right? We can be.
Yeah.
When our kids are our age, we can be multimillionaires,
Mm-hmm.
right? And it's not even that hard. The difference is no one taught my parents this. No one taught Mike's and Fatty's parents this.
Yep.
They didn't know this.
And no one told us this. That's
right.
I think
school sure as hell didn't.
It's not generational. It's a cultural. So it's a paradigm shift, isn't it, Christian? And Mike as well. Like, isn't our age? Aren't we like so sucked into this technological advancement and everything is readily available? You just like one click away in Google, and I can't really blame like past generations or like my parents. It's cultural and it's generational, and there's so many variables as to why people are so put off and have not gotten into investing. And I think, like Christian just said, I think it's absolutely pivotal and very critical that we do it now, because every day passes and you're not doing it. It's like,
well, and people think too, Fatty, like when I say wait 25 years, they're like, oh my God, like you're telling me, like, just thinking about the idea of working for 25 more years makes people want to shoot themselves. And I'm like, that's when we start getting into an entirely different discussion about your outlook on life. When I think about what's going to happen in 25 years, I can't fucking wait.
Yeah.
I cannot wait to see what my life's going to look like in 25 years. Because I'm going to be balling. I'm going to have so much fucking money.
Yeah.
I'm going to be doing whatever I want to do. I'm going to be having fun. I'm going to be running my own business.
You're going to buy the mansion.
Like, I can't wait.
Yeah.
I cannot wait, because having money is fun.
Like,
you know, let's take a quick second and talk about that idea of like money doesn't buy you happiness, right? Everyone's heard that. Everybody's heard that. Literally everybody. I don't care where you live in the world, you've heard that money doesn't buy you happiness.
Yeah.
Mm-hmm.
And I am here to tell you that is bullshit. Money opens the door for so much happiness. Now, if you're pursuing it for the sake of the money itself, you're correct. The money itself is not going to give you any level of fulfillment or happiness.
Yeah.
But what money, there's a country song. I don't know, Mike, if you listen to country music, there's a country song called, I think it's called Buy Me a Boat.
Yeah.
And basically that's his line of the song is like, they all say money can't buy happiness, but it can buy me a boat.
Yeah,
exactly. And that boat's going to make me pretty happy. Like that's going to be fun. You know, that is what money does, man. To tie this back to our initial conversation about financial independence and wellness. When you have money, it means you are beholden to nobody. Nobody has any power over you because you don't owe anybody anything. You can forge your own way in life. You can produce a lifestyle for your kids that you never got to have. You can give back to your community and you can improve the lives of the people in your community. You can quite literally make life better for you and everybody that you care about.
Yeah.
By having money. Like we all know those people who are consistently broke and they're good people. And one of the reasons they're broke is because they're always giving their shit away and they're doing stupid stuff because they have good hearts, right? They're giving their money away to their family members who take advantage of them. They're giving it away to friends. They're giving it to their church. Like they're giving their money away. And it's an admirable thing that they have a heart for other people and they want to help people. But the best way you can actually help people, your community, your family, get rich, dude. Get a lot of money. Do it the right way.
Yeah.
Be ethical and honest about it. Work hard. You know, help other people make a lot of money too, right? A rising tide lifts all boats, right? Don't be the only boat that's going up. Take everybody else's boat up with you. Right. Make everybody rich. Like make all your friends rich. Help them get rich too. Because when you get there, dude, life is just it's so much less stress. You can eat healthier because you can afford it. You can get that nice ass gym membership. Yeah. Like you can buy that nice bike. Like you can do all the things that you want to do and you can live a healthy lifestyle and you can help your friends and family to do it too.
Yeah.
What an amazing statement to wrap up the episode.
Yeah.
I think it's just out there, and all it takes is personal commitment and
little knowledge, little patience, little commitment.
All those
patience key.
I'm gonna
all
pass
good things
over
come
to
with
my
time.
co-host Mike, and I'll obviously I want you to quickly just give us 30 seconds of feedback as someone who's not not been investing, and someone that wants to sort of like share feedback on the session on this podcast and actually let you wrap it up as well, Mike.
Has my sales pitch worked? Is Mike going to start investing?
Actually, I think you sold me when you said 25, 30 years I could be a multi-millionaire or whatever. So and then after that, got me really thinking. Like that was the pitch that got me. So yeah, I'm gonna start looking into it more now because it does seem interesting now, and I think you kind of thought it's kind of free money-ish, pretty much. Like instead of just sitting in my bank, I could put it in there and make some money. So
Abso-fucking-lutely.
Yeah. But yeah, to wrap it up, wise, thank you again, Christian. Thanks, Fadi, again. Thanks for coming and talk to everybody, and thank you all for tuning in. And let us know if you guys like this, and we'll keep bringing Christian on, and he can talk more in depth on. So I don't know if any of the followers are more like in Fadi shoes, know what's going on, or more people are like me and don't have a clue. But thank you all for watching, and tune in next time.
Cheers, everyone. Thanks, Christian.
Thanks guys.
Mike.
Yeah, thank you.
Yeah, man.